hopefully you can see the recordings in case you wanted to have a look. Today's class is quite kind of an extensive, and it's a little bit of a historical journey. So we're starting with a bit of a history of Basel, and we're looking at Basel from two separate perspectives. So what I wanted to cover today is the history of the committee and the core principles of effective supervision before we get into a little bit more on what is the actual Basel framework as we know it, and also how do we actually calculate capital, different types of capital, and what capital actually means. So, interestingly, as always, there are various links, so sources for information that you can go and search. So in terms of the background, when I started risk management, I did it pretty much when Basel I was still in place, and my learnings was all about, here is a capital model that is designed for banks, and therefore banks internationally have to comply. Go on learning. But in terms of my work exposure to banking regulation, I kept seeing a lot of similar terminology in different countries. So, you come across this term, whether somebody is fit and proper, right? So I kept running into that sort of terminology. I kept running into various standards that actually sounded very similar in different countries. You look at, liquidity, interest rate risk management, right? Credit risk management overall. And you look at, say, Singapore, Australia, Hong Kong, Japan, different systems, different regulators, but there is a lot of commonality. And at one stage, I actually came across these principles, and it all started to make sense. So the Basel Committee itself, right, so the Basel Committee for Banking Supervision was formed in 1974, and it followed a number of significant failures. Now, these failures occurred well before you were born, but at the time, the Bank Herstatt failure is one of the best-known examples of settlement failures. And that actually, when we start talking about operational risk, the failure of Herstatt Bank actually reminds me quite a bit in terms of the impact of the Lehman Brothers. The difference is about 35 years between them, but in terms of having a mid-sized institution failing and then impacting, having this global impact, Herstatt Bank did that before. And the losses from Herstatt at the time was something like, I think, 800 million US, and that's $1974. So you can imagine that that's a lot of money by today's standard. So anyway, so there were a number of failures, and what was happening is that the failure of a bank, there would be, say, a branch somewhere that has exposure, and it wasn't really clear where the responsibilities lie. Because historically, if you think about it, if you've got different countries, and within those countries you've got different banks, and each bank operates in its own country, the responsibilities are clear. The regulators in each country regulate their own bank. Then it starts to get a little bit more exciting when these banks, say this bank starts to open up a branch here, and a branch here, and a branch here. Right? Now, technically speaking, anyone here from a legal background? Any chance? If you have a branch, what's the legal status of a branch? What's the legal status of a branch? Does anyone know? Legally speaking, a branch is actually part of the same institution. It is not a separate company, right? So for example, Bank of China, right? you've got Bank of China Sydney branch. It has its own balance sheet, but legally speaking, there's only one Bank of China institution, and the Sydney branch is part of that institution. So you can have a branch, or you can have a subsidiary, or you can have a joint venture. If you have a subsidiary, that means it's a company, separate company that you own. But the branch is not a separate company. So if you have a branch, here is a question: who regulates this branch? The regulator in this country says, well, I don't regulate this entity, and this branch is part of that entity, whereas the regulator in this country basically doesn't travel outside of this country, and they don't regulate it. And then these branches can get up to some crazy stuff and get exposures that are very high. And if this branch defaults on its obligations, that means the entire entity has defaulted on its obligations. So this supervision became very important. And this idea that the regulators came together, and this sort of originated in the G7, and they got together and said, listen, we need to figure out how we're going to supervise branches and how we're going to supervise subsidiaries and joint ventures. So the first document came out in 1975. Again, I've provided these as links, so if you click on it, you'll find this very, very old document. Right? So this is the document that will come up. Right? Very confidential document. Committee on Banking Regulation and Supervisory Practices, report to the governors. Right? And ultimately, they talk about the need for cooperation, and they talk about how are you going to supervise or divide supervisory responsibilities between the host and parent authority. So for this bank, right? So for this bank, there is a parent authority, right? So the parent regulator in this country is the parent. And the regulator for this bank, the regulator in this country is the host. So they are hosting this branch. And the parent regulates the entire entity. And the whole idea was to say, hey, first of all, these guys need to coordinate. And ultimately, liquidity, if you read it, it's only a couple of pages. It basically says, look, liquidity primarily is going to be regulated or supervised by the host regulator for the branch, whereas the capital is going to be primarily by the parent regulator. Because from a capital perspective, it's only one legal entity. So that was really the idea, right? And that came out in 75. Then in 83, they updated the Concordat. By the way, Concordat is a fairly old church word that sort of signifies an agreement to do something. So they use this particular terminology. So it was updated in 83, and then in 92, it kind of, instead of being principles, they actually came out with minimum standards. So they said, all right, it's not just going to be aspirational principles. Here are the standards, and every regulator needs to abide by these minimum standards, which then got updated to in 96 to be the supervision of cross-border banking. So still the focus was on cross-border banking until finally in 97 the core principles for effective banking supervision were developed. Now think about it, 97, so 1988 was when the first Basel standard was designed, and in 92 it was becoming effective. So essentially 92 is a bit of a watershed moment when the first Basel standard comes in, and at the same time the minimum standards come in. In 96, gets updated, and the market risk calculation comes in as well. So then we have these core principles. The idea of the core principles is that the core principles are applicable in any country. So when we talk about the Basel models, right? When we talk about Basel I, Basel II, Basel III, right? So right now, if we're talking about Basel III is a model for capital adequacy. And as we'll see, what the Basel Committee is saying, in order to supervise the banking industry, we need to have certain core principles. Those principles apply regardless of what model you want to use. We need to abide by those principles. In most countries, you do have a Basel-type framework in place. You also, if banks want to be internationally active, they need to use Basel capital model. Right? So for internationally active banks, they need to have a model that's at least on the same path as a Basel model. But the core supervisory principles, they're common sense principles that should apply in any country, in any banking system. So, on one hand, we figured out principles to supervise banks. On the other hand, the question remains, what are we actually trying to achieve? Right? How do we protect the banking industry? So we're supervising them, we know what they're doing, but what are we asking them to do? Right? What's the actual objective? So the issue happened, again, if you think about 1980s, 74, banks are failing, we've got Basel Committee. 1980s was the time when there was a lot of debt, a lot of poor quality bonds being traded. So previously banks bought a lot of bonds issued by emerging countries, Latin America, Africa, etc. 1980s, high inflation, high oil prices, etc. The value of those bonds is starting to fall, they're starting to default. So from banks' perspective, if we go back to our basic, the most basic assets, liabilities plus equity. So imagine we have a bank that invested 100 into corporate bonds. It has 90 in deposits and 10 in equity. Right? The most basic scenario. And now imagine the value of these bonds falls to 91. If the value of the bonds falls to 91, what happens on the right-hand side?
$1 equity and 90% deposit.
So deposit stays at 90, correct, whereas the equity falls to $1. And if this happens, we are now in a situation where we have very limited amount of capital, and if there's any further deterioration in this, the bank technically is insolvent. Right? So insolvent means that the value of your assets is less than the value of your liability. By the way, this issue is a well-known issue, and it happened during GFC, and it's something that you guys in particular might be interested in. There's a lot of talk about how much bad loans is carried by Chinese banks. Because in this situation, if you recognize the bonds as being 100, then it looks like your equity is 10. So as long as you don't recognize the true value of the asset, everything looks okay. But if you recognize the true value, then potentially a bank could go bankrupt. So that was exactly the issue after GFC. So banks have a lot of exposure, and they're saying, no, these are valuable assets, but then if you try and sell them, you can't. And this is where, after GFC, a number of banks separated their balance sheets into the so-called bad bank and the good bank. And into the bad bank, they put all of the stuff that they got during GFC that they didn't want to carry on a going forward basis. So we have a capital adequacy crisis where banks are carrying various assets in the 1980s, and the regulators are saying, we have concerns about the quality, and we have concerns about the true capital that the banks have. So, what's the idea? The idea is then to say, hey, let's figure out two things. One is let's ensure that we remove competitive inequality, and two, let's actually strengthen the amount of capital that's required. So, let's go to a very basic example that kind of drives the entire capital adequacy kind of issue. So let's say we have two banks operating in two countries. They both want to give a $100 loan to a company. So they want to do this $100 loan, and they want to do this $100 loan. Right? So there's a company that wants to borrow $100. The capital standards in the two countries are different. So in country A, this bank has 95 in deposits and 5 in equity. In country B, they have 90 in deposits and they are required to have 10 in equity. Question: who will get the loan? Bank A or Bank B? This is a very good opportunity to get it right. It's a 50-50 proposition. So, which bank will win?
The B is one of them.
You think B will win. Why?
They got more equity.
Okay.
More because you get the loan.
Okay. So why do you think that having more equity gives you more capacity to get the loan?
So you can leverage up.
So imagine that both of these banks, right now, they have this $100 in cash. Right? And they want to lend this cash, they want to convert this cash to a loan. Who will be the winner? Why?
Because the reservation cost is low, like the cost you put in equity is low.
Okay. You guys have done finance, right? This is not your first finance subject, right? So you have covered this foreign concept of weighted average cost of capital, WACC, right? WACC is not, like, it fundamentally makes sense. Remember, WACC is about cost of weighted, proportion of debt times the cost of debt plus proportion of equity times the cost of equity. And you can also incorporate the tax sheet. Which is more expensive, debt or equity? Equity is more expensive, correct. So if you have more equity, what will happen to your overall WACC? High. All right. So therefore, this bank has higher cost of capital compared to this bank. If they have higher cost of capital, what does that mean for any project that they want to take on?
Risky.
And more importantly, they want to get higher rate, correct. So now we have two banks, they have higher cost of capital. If they're pitching for the same loan, what can Bank A do? Correct, they can offer a lower rate. That's exactly right. And that is the entire point. If I was to summarize the whole idea of capital adequacy, and the current arguments about how much capital is appropriate, right? It's not about just saying more capital is better. More capital makes the bank safer. But more capital increases bank's cost of capital. And if we increase the bank's cost of capital, the bank will charge more for the loans. So, from next year, we can increase the capital for Australian banks, but that does mean that they will need to charge more, including higher loan rates. Okay? So, if we have two banks in two different countries, and they're subject to different standards for capital adequacy, then the bank that has lower capital adequacy will win. And then you have competitive inequality, and you have a race to the bottom. Each country will try and make their banking system more competitive by offering lower capital ratios. And the regulators are saying, hold on a second, that does not make sense. And they're saying, first of all, we're not sure whether this is the right number. Right? We're not sure that the current levels of capital are good enough. Plus, we are seeing countries and banks compete on level of capital as well. So that doesn't make sense. And that was the whole purpose of Basel I. So Basel I came in and said, hey, let's define a common minimum amount of capital required. Right? Let's define what is capital, define the minimum amount, and then say any country that wants their banks to compete internationally has to abide by this standard. That was the whole concept of Basel I. That came out in '88, but it only became effective, so countries had to comply by '92. Right? And then in '96, the market risk addendum came in. So the original Basel I only dealt with credit risk. So you were only looking at how much risk, how much credit risk do banks carry, and based on the amount of credit risk, what is the minimum amount of capital that they're required to hold? We'll come to the equation. In 2004, Basel II standard got introduced. In Australia, Basel II got rolled out quite quickly. Not every country did the same. So US was one of the last countries to try and implement Basel II, and they hit GFC with their banks still operating under Basel I. So a number of US banks, because then GFC hit and they were more concerned with just surviving, a lot of them, Basel III was drafted in 2010, and a number of US banks basically went from Basel I straight into Basel III, bypassing Basel II, which was also quite interesting. So, coming back to the core principles. So the core principles, as I said, came out in '97, and there was also an assessment methodology. And basically what you have is these principles are used by the World Bank and the IMF to do assessments of other countries. So IMF travels around, comes to a country, says, all right, we'll do an assessment of this country's banking system, and we'll assess the banking system against these core principles. Then the principles got updated in 2006, and again, timing-wise, worked out brilliantly. They updated them, GFC hits, clearly the standard's not good enough. So then they revised them as well, post-GFC. So we now have 29 revised principles of effective supervision. I don't have enough time to go through all of them, right? But they are quite valuable. So if you wanted to know about how a country's system is structured, you can look through these principles, and pretty much any country you go to, their banking system complies with these principles, right? Because they do get regularly assessed. The key differences is that under the 2006, the principle 1 was objective, independence, powers, transparency, and cooperation of supervisors. That was split into 3 separate principles, and a corporate governance principle was also introduced, and accounting and disclosure got split. So it's interesting that the corporate governance standard got introduced, and we'll talk about what that is. So, what are the principles? Right? So as I said, there are 29 of them, and they're split into 2 categories. The first category is really about the supervisors. So it's all about the system and the supervisors themselves. So principle 1 talks about that you need to define the responsibilities of supervisors. Principle 2 talks about that supervisors have to be independent. So for example, right now, chances are next time Turkey gets reviewed by IMF, they will have significant issues, as will India. Because in both of those countries, there's been significant clashes between the government and central bank. So in India, the head of a well-respected head of central bank left, and the same thing happened in Turkey, where the head of the central bank was replaced by the nephew of the president. So the principle says the regulator has to be independent, and there's a process for appointments, etc. Has to be accountable, has to have sufficient resources, including sufficient resources to undertake on-site reviews overseas of their regulated banks. And the supervisors must have legal protection. So that means you cannot sue supervisor for something they do as part of their remit. 3 is cooperation and collaboration. So the supervisors have to work together. Permissible activities, so 4, it means that supervisors need to define what is it that banks are allowed to do. So if you look at the Banking Act, you will see that in the Banking Act it says what the banks are allowed to do. 5 defines licensing criteria. 6 says that transfer of significant ownership needs to be subject to regulatory approval. So that's why in most countries, ownership of banks is subject to additional restrictions and approval. 7, any major acquisitions are subject to regulatory approval, and major disposals as well. So recently there was a proposal by one of the major Australian banks to sell an insurance unit in New Zealand, and they kind of forgot to ask the Reserve Bank of New Zealand. They announced it to the market to say, oh yeah, by the way, we're talking to the regulator. And then the regulator in New Zealand said, no. So that was kind of quite embarrassing. 8, supervisory approach. So supervisors have to set out how they're going to supervise banks, what techniques and tools they're going to use, what reporting will occur, what sanctions they can apply, how they will apply consolidated supervision of banking groups. And 13 is home-host relationship, right? So that's basically home-host relationship between regulators. How do they cooperate? So that's the core principles on supervisors. And then the principles that apply to banks, right? So prudential regulations and requirements. So the first one that was introduced is corporate governance. We'll spend time in week 9 talking about corporate governance, but out of interest, what do you think corporate governance is? What does the term actually mean to you?
A well-defined risk management team.
Good start, right? Risk management is an important part of it. But it's actually more than that.
To align interests, with budgets and shareholders.
Aligned interest, that's That's kind of theoretical, theoretical models of finance, right? Shareholder primacy, etc. And that's part of governance in that sense. But banking regulations are a little bit more specific. And this is why, again, you look at these terms, if you look at these terms, most countries, you look at their banking standards or banking regulations, you will see specific standards addressing these points. So governance is about how do you govern the institution. What are the actual ways you govern? And it talks about having a board of directors, qualifications for the board of directors, committees, who are the types of personnel, and do they have to be fit and proper, and the approval from regulators for key personnel. So that's the kind of requirements that apply under the heading of governance. And interestingly, before, so heading into the GFC, there was no separate requirement to do. So we've got corporate governance. And then, 15, risk management process. That one is fundamentally, you look at it, you read it, that explains what we're going to cover over the next 5-6 weeks. Because that explains what is required in order to manage risk, how to establish a risk framework. And in order to comply with that principle, in Australia, we have a prudential standard that was actually quite a recent prudential standard, CPS 220 risk management. 16, capital adequacy. That standard, so risk management is about framework to manage risk, whereas 16 talks about setting up minimum capital requirements. So all of those standards to say how much capital you need, how to calculate minimum capital, that's in compliance with 16. Okay. 17 is a standard about what's required to manage credit risk. 18, problem assets. So again, you look at Australian standards, you've got APS 220, credit risk, and then you've got APS 221, which would be large exposures. So 220, APS 220 talks about credit risk and managing problem assets, and 221 talks about large exposures. I don't know why, but APRA released two prudential standards with the same number. One is called APS 220, the other one is called CPS 220. When that happened, and they flagged it, I actually asked that, I'm like, guys, you've got a 3-digit number, why did you pick the same number? I don't know why. So CPS 220 is risk management, that's addressing standard 15. APS 220 is credit risk. Transactions with related parties. So there's a specific standard that talks about how to deal with transactions with related parties, because a lot of the scandals that happen involve related parties. A lot of the large corporate scandals outside of banking. So HH collapse in Australia, Enron collapse in the US. We had Babcock and Brown that failed. All of that involved related party transactions. Country and transfer risks. So that's just part of credit risk. Market risk, how to manage market risk. Interest rate risk in the banking book. And again, you can see what the terminology is and how it comes. So in Australia, we have a prudential standard that is called interest rate risk management in the banking book. Liquidity risk, operational risk, internal control and audit, financial reporting and external audit, disclosure and transparency, and then the last one, abuse of financial services. To be honest, I don't know exactly why that one is done as a separate one. I wasn't at all involved with, and I don't know the background. But that last one is about money laundering. So if you think about when the regulators come in, and when I say World Bank or whoever comes in to do a review of Australia, a lot of it, this one is dealt with by Australia. Most of them are dealt with by APRA, some of them are dealt with by the Reserve Bank, but that last one is dealt with by Australia. So, just to give you a little bit of an idea, so home-host relationships, you've got the actual principle itself, and then you've got the essential criteria, right? So and the essential criteria tells you what you need to do in order to satisfy the principle. And you've got, as I said, you've got the principle, essential criteria, then you've got additional criteria. So if you actually look at the core principles document, it's a book, right? I'm just summarizing it a little bit. So it talks about, the fact that you need to have a lot of cooperation. And if you look at the first essential criteria, home supervisor establishes supervisory colleges for cross-border groups. So what are supervisory colleges? So imagine if you've got a bank like Citibank. So Citibank operates in 50 countries, 60 countries. And its headquarters in the US. So it's therefore, its home regulator is, say, OCC, the Office of the Controller of the Currency. How does OCC get a full view of their activities? So the supervisory colleges is about the home regulator organizing a get-together of all the key regulators from around the world that supervise a particular bank. So for Citi, you might say the key regulators would be PRA and FCA in UK, and would probably be BOJ in Japan, and would be SFC and HKMA in Hong Kong, right? So a supervisory college is when there is usually a formal meeting of supervisors, and they review the key banks under their supervision to make sure that the story is straight. And the corporate governance, you can see the standard says the banks must have robust policies, processes covering organizational structure, control environment, responsibilities of board and senior management, and compensation. So the board is responsible for corporate governance. The supervisor regularly assesses governance. The board members are suitably qualified, so they're fit and proper. The board must approve strategy, risk appetite, culture, values, and conflicts. So you've got fit and proper standards, and that's where the terminology. Like you go to many countries and you find this fit and proper standards. I was wondering, where the wording came from. You must have remuneration arrangements to align to prudent risk-taking, et cetera, et cetera. So that's the corporate governance standard, right, that each country needs to then incorporate. The risk management process. So this is where banks must have a comprehensive risk management process to identify, measure, evaluate, monitor, report, and control all material risks on a timely basis, and assess the adequacy of the capital and liquidity in relation to the risk profile. Okay? So, in short, that's what you need to do. Okay? You need to know what risks you're taking, control those risks, have appropriate policies, and then separately have appropriate capital and have appropriate liquidity. And then you can have, it kind of breaks down into the various criteria. So you can see in the principles, the board has a very significant role to play. So it does talk a lot about what is the board doing. Part of the responsibilities is that you need to have sound risk management culture. Now, in Australia, we just went through the Banking Royal Commission, and you really have to question whether the regulator has been successful in establishing the requirements for boards to have sound risk management culture. Banks must have comprehensive risk management policies. You've got risk management strategies, policies, and processes. The regulators, the board and senior management must obtain sufficient information to understand the nature of the risk. Again, there's a question mark there. The banks must have appropriate internal process for assessing their overall capital and liquidity adequacy. Information systems must be adequate. This one is quite interesting. 8. You must understand the risks inherent in new products, material modifications, and major management initiatives. So if you look at the CBA scandal in relation to anti-money laundering, they did not fully understand the risks in a new product. They were introducing smart ATMs, they didn't fully assess all of the relevant risks, and they missed the AML risk. Risk management functions must cover all material risks with sufficient resources, independence, authority, and access to banks' boards. Again, if you look at APRA's review of CBA, the staff, there wasn't enough staff, they didn't have sufficient authority, and there was not sufficient representation at the board and senior management level from risk management, from non-financial risk management perspective. You must have a chief risk officer, right? And if you actually change the chief risk officer, it needs to get approval from the board and should be disclosed publicly. Standard risks are, in particular, credit, market, liquidity, interest rate risk, and operational risk. And you also need to have BCP. You need to have stress testing. You need to account for risks in terms of new activities. So that's just, again, the actual principle is much longer. So this is a short summary. What do we have in Australia? We have our CPS 220 risk management. This is just a short summary of that standard. But that standard came out to align Australia closer to the requirements of the core principle number 15. Right? So CPS 220 says that a bank must maintain a risk management framework, must have a board-approved risk appetite statement, must have business plan, adequate resources, and notify significant breaches. The actual standard itself goes through pages and pages. I was very happy when it came out because one of the things it talks about is that each bank needs to have adequately resourced and knowledgeable compliance function. So I was the compliance function at the bank, so I said, hey, needs to be adequately resourced. So if you don't give me enough resources, I'll say that I'm not adequately resourced and you'll be in breach. So, just to go back, these are the core principles that have been updated as of 2012, and these principles apply to how we supervise banks in most jurisdictions. Right? Then we move on to the next part, which is the Basel Capital Framework. So, Basel Capital Framework is just a part of the overall management of financial systems. Right? We, in risk management courses, we mainly dealt with that part. Right? So historically, we mainly dealt with that part, but it's just a part of the overall picture. So, what happened when Basel I came out? Basel I had fundamentally two pillars. Pillar 1 defined what minimum capital standards were, and then Pillar 2 established a supervisory review process. And if you think about it, they are two separate steps. So the regulators say, hey, here is a model that you need to use to calculate their requirements. Banks then apply that model to themselves, and they calculate their minimum requirements. Then the supervisor comes in and reviews. So, what actually happened? One big thing is under Basel I, they actually defined what is capital. That hasn't happened before. So there was an actual definition of capital for the first time. And then they also said, we will have this calculation based on risk-weighted assets. So therefore, if we go to our Basel equation, so the idea is not to say how much capital should a bank have in absolute terms, but rather we have minimum capital ratio, prudential capital ratio, and that will equal to the amount of capital divided by risk-weighted assets. And under Basel I, it had to be greater than 8%. Right. So they, for the first time, they defined what do we mean by capital, and they also defined how to calculate risk-weighted assets. Right. So it's not based on gross assets. It's not just saying if your assets are 100 and your liabilities are 90, you need to have 10 in equity. It's rather saying it's not gross amount of assets, but it's actually risk-weighted assets. So let's have a look at how much risk you're carrying. And then based on the amount of risk, 8% of risk-weighted assets is capital. Have you guys done that calculation? The risk-weighted assets calculation on capital, right? That's the idea of Basel I. Then in '96, the traded market risk came out. And the traded market risk basically said you can use the standardized approach or you can use the internal models approach. The internal models approach is VAR. Right? So then they said you can use VAR or you can use the standardized approach. When we look at market risk, we'll actually do a calculation based on the standardized approach, just so that you can see how to calculate market risk for the standardized approach. So in terms of this ratio was known as the Cook ratio, because Peter Cook was the chairman of the Basel Committee when it was introduced. So this whole equation was kind of his baby. And the total capital was core capital plus supplementary capital minus deductions. Okay? So that's how we calculated capital. What were the requirements? Basel I requirements were extremely basic. Very, very, very basic requirements. Essentially, to calculate the risk weights, you had to assess items on the asset side. And you had, fundamentally four categories. You had 0 risk weight category, 20% risk weight category, 50% risk weight category, and 100% risk weight category. So in other words, you look at your gross items, multiply it by the appropriate risk weight, calculate your risk weighted assets. Add them up together, multiply it by 8%, that's the minimum amount of capital you need to hold. Now, if you want to borrow if you want to get a home loan, what percentage of the value of the house will the bank lend to you, generally? $70, $50? Any other takers? Anyone have to go through that pain and suffering of the mortgage?
80?
80? I'll take 80, right? So historically, the cutoff or the big distinction in Australia was around 80. Now, in Australia, mortgages below 80% loan-to-value ratio, the risk weight was 50%. More than 80% loan-to-value ratio, the risk weight was 100%. Which means it would take twice as much capital. And for Australian banks, it was very simple. You want to get a loan, 80%. Now, under Basel III, that calculation has changed. So now it depends on whether it's an owner-occupied or an investment loan, depends on a lot of other factors. But under Basel II and Basel I, it was very simple in Australia. 80%, you get 50% risk weight, etc. And then you also had to incorporate the off-balance sheet items as well. So the idea for the on-balance sheet items, as I said, very simple, multiply through, work out how much it is, and you're done. For off-balance sheet items, so I guess the first question is, what items are off-balance sheet items? Derivatives, why? By now you should have worked out that that's my favorite question. Why? Why do we put things off balance sheet? Why are derivatives not on balance sheet?
OTC.
Okay, OTC, over the counter, why? Why are they not on balance sheet? Why are they off balance sheet?
Because Lord shares as you use derivatives, so you can't say you have these kind of assets for liability.
Okay, I will take that answer, right? Items on the balance sheet are relatively certain. Right? Things that are off balance sheet are things that are not as certain or not certain enough to be recognized on the balance sheet. So when it comes to derivatives, if we enter into a swap today, and it's a 3-year swap. Today, the value of that swap is 0, right? Because we do it on market terms. In the next 3 weeks, 4 weeks, the value will start to change because each day the interest rates will change. But we don't know what will the end value be because the changes will continue to occur. So that's why derivatives generally are off balance sheet because the value is uncertain. Also, various contingent liabilities and contingent assets are all off-balance sheet items. So to work out, if we've got a balance sheet, let's say if we've got assets, let's say we've got cash, 10, bills, the bank bills, 50, mortgages, 100, and corporate loans, 100. Right? So in terms of the risk weights, for cash, what's the risk weight? 0. For bank bills, how much? 20. So we'll go 20%. Yeah, so this was OECD banks, but yeah, ultimately, if it's a bank bill, is a claim on the bank. Right, so if you invest in bank bills, 20%, mortgages, 50, and corporate loans, 100%, right? So if then we calculate risk-weighted assets, then that will be 0, that will be 10, that will be 50, and that will be 100. Add them up together, and we'll go at 160. And if we wanted to know minimum capital, so minimum capital equals to 160 times 0.08, which is 12.8, right? Okay? That's kind of the basic calculation under Basel I for on-balance sheet items. So then, what do we do for off-balance sheet items? For off-balance sheet items, we need to figure out what is the equivalent amount to the on-balance sheet items. And to work it out, let's say if I have a swap, again, we're talking about credit risk. So we're trying to estimate how much credit risk there is. If I have a swap with you, and it's on my balance sheet, and the value of that swap right now is plus 3 million. What does that mean? If I have a swap on my balance sheet, and the current value is plus 3 million, what does it mean? Yep. So what does it mean for me? That it's, what does plus 3 million represent? It means that if we finish the swap right now, you owe me 3 million. So if we finish the swap right now, my credit exposure to you is 3 million. You owe me 3 million. Okay. But is that the full extent of my exposure? What is the full size of my credit risk? The full size of my credit risk is what you owe me now, plus there is a potential that you will owe me more money. So I need to estimate how much more money could you owe me, realistically. And this is where for derivatives, if you want to know how to calculate the amount of capital, first of all, you need to figure out what's the current value. So how much money do you currently owe me? If the value is 0, or if the value is minus 2 million, if the value is minus 2 million, that means I owe you 2 million. There's no credit risk in that for me. There's credit risk for you, but no credit risk for me. And in terms of the potential exposure, under Basel I, and when I was doing the subject, this just came out. This was very fresh on the press. So you look at what's the maturity of the instrument and what type of instrument that is. So if we're talking about a 3-year, so in this case we're talking about a 3-year swap, interest rate swap. So 3-year interest rate swap, the conversion factor is 0.5%. So if the nominal value is 100 million, 100 million times 0.5% is $500,000. So if my current value is 5 mil plus the potential value of $500,000, that means my total exposure is 5.5 million. That's the equivalent. And once I have this equivalent number, I then need to figure out, so my interest rate swap, I've now figured out that the value of the interest rate swap is 5.5 mil. I still need to apply a credit, a risk weight. And the risk weight will depend on what? the risk weight will depend on who my exposure is to. If my exposure is to the government, then the risk weight will be 0. Because claims on governments have a 0 risk weight. If this swap is with a bank, the rate will be 20%. If this swap is with a company, then the risk weight will be 100%. Right? So there is this two-step process, and I'm sure you've covered this before. Hopefully. All right. Any questions? I know I'm moving fast, but I know that this lecture I never finish on time. There's so much to talk about, and I get very excited, and we never finish on time. So I'm trying to move fast, but just do ask questions if you're not clear. Because right now we are getting into the basics of how the Basel framework works. Right? We've got the core principles, and now we've got the Basel framework. All right, going once, going twice. No questions? All right. Capital. In terms of capital, when I draw up these basic assets, liabilities plus equity, right? We always go, equity, that's our capital. Right? And that's a shorthand. Now, in terms of how capital is actually calculated, you look at paid up capital under Basel I. Paid up capital, disclosed reserves, then some Tier 2 capital. Now, technically under Basel I, it also talked about Tier 3 capital. But in Australia, APRA never recognized Tier 3 capital. In Australia, APRA also was not very keen on Tier 2 capital. So in actual fact, the quality of capital in Australia was much higher than the quality of capital in the US. So if you look at, again, if you look at a typical textbook, it always talked about different types of capital and how to get to your minimum 8%. In Australia, banks historically had the vast majority of their capital as Tier 1. So we had very little Tier 2 capital. And we still do to an extent. And then, once you've calculated your total capital, you have to apply deductions. So you have to subtract some things. And things you need to subtract is investments into other banks. So if you invest your capital into, if you buy shares of other banks, you have to subtract it. Why? Why do you think that if your bank invests in other banks, you have to subtract it from a capital perspective? That leads to a more fundamental question. Why do we want to know the minimum capital? Why do we calculate the minimum capital? Okay, to prevent the potential loss, to prevent potential benefits, right? Okay, I'll take it. Right, so we want to know the minimum amount of capital to prevent potential benefits. Okay. So then, when do you think potential bankruptcy can occur? Like what kinds of things will drive the bank to go bankrupt? Yes?
So reserves are less prices, market risk, potentially.
Okay, so crisis, right? So you have a crisis and the bank goes bankrupt. Right? There's two things. One is it's much more likely to be a credit issue as opposed to a market risk issue, just because banks in Australia and Asia don't take as much market risk. But I take your broader point. We have a crisis. Through the crisis, bank suffers losses and goes up. So now, why do we deduct investments in other banks from capital?
Because of the correlation, you need to know. So the thing is, if one falls, the other has a major possibility, the other possibility of falling increased by the previous fall, so you can actually own that kind of.
Absolutely right. Banks are likely to fall, if you think about GFC, that's when banks tend to suffer issues. And that's where, if you've invested into other banks, they're more likely to have issues. So your investments, right? So if you've got your balance sheet and you've got your, say 100 in cash, and you've got investments into bank X, you have $20 of investments into bank X, and then you've got, say, $30 of capital, of equity, and say 90 in deposits. If a crisis hits, then you're likely to suffer some issues. Let's add some more loans. So let's say you've got 100 loans. Let's say you've got bonds, also 100. So let's say if a crisis hits and you lose $15 on your loans. So you lose $15 on your loans, you lose $15 from capital. But if the value of your investment, if the other bank also suffers, the value of the investments you've made might also fall. Let's say another 10. So then, that other 10 will also hit your equity. So therefore, the idea is that capital is calculated to prevent banks from going bankrupt in terms of potential losses. And if that's the case, therefore, you have to deduct it even before. You need to satisfy minimum capital requirements, taking into account that this particular investment could blow up. And then using similar idea, what about goodwill? What is goodwill?
Intangible asset.
It's an intangible asset. What does it represent? Reputation. Yep, excess value, which is?
The excess value of the market value.
Okay, so we have the, you pay a price for something above its intrinsic value, right? So you would say reputation is a good one, right? Now, why do we deduct goodwill?
You can't quantify the amount of asset.
Well, you can quantify it, but you can't recognize it, right? In a crisis, your reputation, Lehman Brothers had very valuable reputation, very valuable brand name, valuable systems and tools. It was all very valuable if Lehman Brothers continued to operate. But in a crisis, those assets are useless. You can't sell or recognize value in those assets. So if you have a balance sheet that has goodwill as an asset, you know that in a crisis that asset goes to zero. So therefore, for the purposes of capital adequacy, you do apply the entire amount of goodwill as a deduction. So, what were some of the problems with Basel I? Multiple problems. One was regulatory arbitrage, because essentially banks figured out that by moving things off balance sheet and onto the balance sheet, you could determine the amount of capital required. Right? So if you move something off balance sheet, gone. Right? So if you do securitization, gone. And the other problem was that the minimum capital requirements were very small. And most banks had capital well in excess of the 8%, because that was 8% of risk-weighted assets, and the calculation was not very punitive. So therefore, this whole model was not practically working to constrain what banks did. So for the model that we had was total risk, was risk-weighted assets for credit risk, and then risk-weighted assets for market risk. That's when we added market risk calculation. And then market risk was defined as general market risk plus specific, and the general market risk itself was also defined, and we'll talk about market risk when it comes to it. In '96, the internal model became available, so that was the value at risk methodology, and also the Tier 3 capital, as I said, was introduced, but in Australia, APRA never recognized it as being required. Whereas in US in particular, they did start issue Tier 3 capital. So that's fundamentally Basel I, right? And then Basel II came up. When Basel II was coming in, it was seen as a very fundamental upgrade of the Basel framework. And this is what we faced the GFC with. Right? So, first of all, we now have 3 pillars. Right? We had 2 pillars before, we now have 3 pillars. Minimum capital requirements, supervisory review, and market discipline through disclosure. Capital was better defined. And then risk-weighted assets. So we continue to have credit market risk. Credit risk, we do have 2 approaches for credit risk. But we also have operational risk. We also have non-traded market risk. Non-traded market risk is the interest rate risk in the banking book, which is quite interesting. So in Australia, interest rate risk in the banking book is part of Pillar 1. In some other countries, interest rate risk in the banking book is considered to be part of Pillar 2, as in an additional obligation imposed by supervisors. Whereas in Australia, it's a core obligation that you have to calculate yourself, whereas other jurisdictions becomes part of Pillar 2. The idea of market discipline disclosure is quite interesting. Right? As I said, what the purpose was is to say, when we went back to our example, when we went back to, say, 2 banks, right? If we have, the 2 banks, A and B, and in this case, A has 5 in equity, and B has 10 in equity, right? So, which bank would you take the loan from? You would take the loan from A. Why?
Less equity and less cost of capital, and it's less than equity.
Okay. So I would say you will take the loan from the bank that will offer you the lowest rate. And it's most likely to be Bank A that they will offer you the lowest rate. So when you're making a decision who to take money from, you'll take the cheapest money. If you were to start trading with a bank, or if you wanted to place a deposit, which bank would you place a deposit with? Bank B. Why? Because it's safe. Okay, agree. Right. So this simple example highlights that you would want to make a distinction based on the capital structure of the bank. So the whole concept of Pillar 3 was to say, you know what, let's force banks to disclose how they take risks, how they calculate capital, how much capital they hold. So that then market participants will review each bank's practices and they will make decisions and they will punish banks that don't manage risks well and they will reward banks that do manage risks well. So as I said, if you Google Pillar 3 disclosure, you can put your own bank's name in it and you will see a document that explains how your bank is managing risks. The interesting point is, I think that as a theoretical concept, it works. In practice, I think it fails dismally. Because I'm pretty sure none of you reviewed Pillar 3 disclosures before you made your banking decision. You know, I'm very, very comfortable saying that. And I'm pretty sure that in the industry as well, people don't really review Pillar 3 disclosures. But nevertheless, under Basel II, that's an entire pillar of the model, say it's important. All right, so that was Basel II. So now you've got minimum capital ratio, credit market operational, in Australia also interest rate risk in the banking book. In terms of credit risk, and we'll come, when we'll start looking at credit risk, we'll go through this in more detail. We're looking at standard model, which is using external ratings, or you have two internal models, basic IRB and advanced IRB. So on the basic IRB, you just calculate the probability of default, and under the advanced IRB, you calculate all the different risk components. So, one of the biggest issues or drives with Basel I was that all corporate bonds were treated the same. So whether you're lending to a AAA rated corporate or you're lending to a BBB rated corporate, the risk weight was the same. If you think logically about this, if you had a choice of lending to a AAA company or lending to a BBB company, and you are subject to the same risk weight, the risk weight is 100%, who would you lend to? Why?
Same.
Okay. See, you're not playing by the rules. So if you're lending to a AAA company or a BBB company, let's say, who are you going to charge more? Okay, so let's say we'll charge these guys 6%, we'll charge these guys 5%. Okay? Why do you want to lend to AAA?
It depends on annual recovery rate for BBB.
Okay.
No, we are a lender, we should lend to be, because it's the same risk like.
Correct. Right? You're applying common sense, and that's dangerous. Right? Because here, the model tells you the risk weight is the same. If you're lending $100 for each, how much capital will you need to support both of those? Same. And you will need $8 million in capital to support both of these loans. So your weighted average cost of capital will be the same. So if your weighted average cost of capital for both loans is the same, which investment will give you a higher return? BBB. So logically you would say, I want to lend to AAA, it's safe. But looking at the model actually tells you it makes sense to lend to a worse company. And that's actually exactly what was happening. It made sense to if you do happen to lend to good companies, it makes sense to securitize those loans and keep the bad loans on your books, because then you're getting higher returns for the same amount of capital. So under Basel II, this approach started to change a little bit. So under Basel II, we now have distinction between credit ratings and also between country risk ratings, banks ratings, and corporates ratings. So under Basel I, all corporates were in the 100% bucket. Under Basel II, AAA would get a risk weight of 20%, a BBB would get a risk weight of 100%. So that means BBB would require 5 times as much equity as AAA. Make sense? So that was an improvement, right?
But also there's still a problem because how you going to rank this?
So in terms of ratings, that's a very good question, right? And you can see that if it's unrated, then you vote for corporates, it's 100%, countries 100%, banks 50%. Now, most large companies are rated, and most banks are rated by rating agencies. But smaller businesses are not rated. Right? Now, these ratings, they generally applied only for the standardized approach. The other approaches, the internal ratings approach, the whole idea of the internal ratings approach is you had to develop your own methodology of how to assess the ratings equivalent for different clients. But that was the idea. Now, this is quite an interesting view. What do you do when you make a loan? When you make a loan, do you expect losses to occur on that loan? And the answer is yes. On average, you expect some losses to occur. And depending on what the ratings are, you can actually convert ratings into expected losses. So, if it's a AAA rating, then the probability of default is something like 6 basis points. So 0.06%. So, when you make home loans, you expect a certain percentage that will default. Right now, the arrears levels for home loans is running at about, say, 0.6%. What happens with your expected losses? How did we go with our accounting courses? What do we do with expected losses?
You make a provision for it?
You make a provision. So every time you make a loan, you estimate what your losses you expect, and you make a provision for it. And those provisions, they do appear on the assets, liabilities plus equity. Provisions do appear in the equity part of your balance sheet. The capital we calculate for prudential purposes is not about this. Those provisions, right, the expected losses are covered by provisions, right? And then what is capital about? Capital is really about covering the unexpected losses. So if you think about it holistically, when you, this is a probability density function, right? So, when we make a loan, if we make a lot of loans, we can expect that the probability that none of the loans go bankrupt is very small. Right? that, if we make 1,000 loans, the probability that we don't suffer any losses is very small. Right? We expect that there will be some losses. So we don't expect too much, but we might expect, and we also don't expect every loan to go bankrupt. But we expect a certain number of loans to go to default. If we calculate expected losses, all of the expected losses should be covered by our provisions. At the time we make our loans, we set money aside. We then figure out what do we consider to be the worst case scenario for our purposes. So this is where we talk about 99th percentile worst case scenario, 99.9% worst case scenario. The aim is not to have capital such that 100% of cases are covered. If you want 100% of cases covered, then your entire balance sheet will be equity. Right? But you figure out what is the level of risk you're prepared to tolerate. Let's say 1%. And if you're prepared to tolerate 1% of risk, then this is the amount of capital that you will end up holding. In basic terms, that's the model for capital calculation for credit risk. For market risk, it's actually similar. The only difference is that for market risk, you expect that loss is zero. When you do trading, you don't expect any loss. When I enter into a swap, I'm not expecting to make a loss. My expected value is zero. So when we talk about market risk, this number is around zero, so we figure out how much capital we need. So we'll talk about it more when we talk about credit and market risk. Operational risk, we'll spend some time on operational risk. Interestingly, I think the operational risk model has not worked very well at all. And there's been some real struggles. So originally under Basel II, they recognized three approaches. They recognized the basic indicator approach, which was you hold 15% of your gross income as capital for operational risk. APRA didn't accept that approach, so never got introduced in Australia. Standardized approach is to use different calculations and work out how much capital you need. Internal measurement approach was basically do this type of calculation for your losses. So to work out what's your average expected losses, and then work out what's the distribution of losses, and make sure you have sufficient capital for 99.9% of cases. And my view, and this is just my personal view, is if you looked at how much capital Commonwealth Bank set aside for operational risk, there's no way that that amount took into account the types of losses that they have since experienced. As we talked about last week, the cost of remediating issues identified in the Royal Commission are 10 billion. And that's pretty much all operational risk. And I'm very certain none of the models at any of the banks predicted or forecast or allowed for necessary capital to cover those risks. All right, let's take a quick break, and then we cover what Basel II did wrong. I told you, I always kind of run late.
That was the database. And I think nowadays the database it is located in China. So I have to go to China to do exam.
You will be in China.
Yes, I have to fly to that China for 1 or 2 days to China. Not to
And the best is China or
it is quality.
I get it. I'll speak to the school. I'll go to I'll speak to the school and see what they
I think I'm probably going to get it if it is rather. I think I'm asking too much. Thank you very much. How much people can you allow the phone of the group?
in a group? Usually 4. Usually people do ask. My view is 5 is more challenging, right? So more challenging for you to coordinate and present a single piece, right? So I will allow 5 if you choose to, but I'm just flagging that it is more difficult to coordinate 5 people, and it's more difficult to create something that reads well as a single piece.
哦，对，626
然后我就放弃HD了，然后就是我现在学习只有2门课都是之前的，然后已经放弃把 HD 就放弃了。
I'm not like very but I want to go back home. Hey, I didn't realize that you see me.
Yeah. My eyesight got worse.
Huh?
My eyesight got worse.
Your eyesight, oh yeah.
It got worse.
How is it like? Was that like the short time?
Yeah, the short side's 4
Oh,
now I got like
like,
C double negative to something like that.
oh. No, I need to find around.
Yeah. Is that
Yeah, it's very hard. I'm sure you tackle a lot. I think thank you.
All right. Let's get back to it. As I said, this lecture is the one that I always struggle to finish on time. So, how did we go with Basel II? When Basel II was introduced, and I found some really nice sort of speeches at the time. When Basel II was being introduced, the view was that it is so much better than Basel I, and it addresses the issues and it addresses additional risks that Basel I didn't cover, so therefore it's a really good model. And it just got introduced in many countries, GFC hit, and very clearly it was apparent that Basel II did not work. How was it work? How did it not work? Number one, under Basel I and Basel II, what was the actual minimum capital required? The minimum capital required was 8%. Question, why 8%? Answer, nobody knows. 8% was chosen as the figure that seemed right. Historically, if you go back to the very beginning of the 20th century, people were using like 10% of total assets, right, or 10% of liabilities 10% seems to be like the figure in operation, and then they went 8% of risk-weighted assets. And under Basel II, they also said, yep, 8%. GFC hit, they said, no, actually 8% is not enough. And now we're going through various models to say it needs to be more than that, but I actually haven't seen analysis that said, why are we saying that 8 is not enough and 12 is enough? It's all about relative comparisons. So capital itself was not enough. The second issue, and by the way, this slide, this is kind of the summary of the GFC, right? In terms of how the banking regulation and the banking system failed during GFC. So item number 2, capital requirements were cyclical and reinforced business cycle fluctuation. Now, we saw that under Basel II, the amount of capital is driven by the rating. So the higher the rating, the lower the risk weight, the less capital is required. So, if the economy is growing well, so if the economy is growing, what happens to your clients? Is their credit quality improving or declining? Improving, right? So if the economy is going well, the credit quality of your clients is improving. If the credit quality is improving, build the logical steps. What does that mean? What does it mean?
Less risky.
All right, they're less risky. What does it mean from a capital perspective?
Less capital.
So the ratings are going up, so the risk weights are falling, so the minimum required capital is falling, which means that you can do one of two things. If minimum capital requirements are falling, what can you do?
And more.
You can either reuse the capital to add more loans, or you can reduce capital by paying dividends and returning capital to shareholders. So if the economy is going well, banks are lending more money. If banks are lending more money, what happens to the economic growth? It accelerates, right? Banks lend more, it accelerates. So if the economy is going well, banks are fanning the flame and they're lending. If the economy hits a stop and there's some problems, asset bubble or some losses, and the economy is starting to go down. If the economy is going down, what happens to the credit quality of your clients? It's going down, correct, it's declining. So now, as the credit quality of the clients is going down, what does it mean for capital? Your minimum capital requirements are going up. If your minimum capital requirements are going up, what can you do?
Sell assets.
So either sell assets or, so what are your options?
Raise capital. Raise capital.
You can either raise capital, you can raise equity, correct. And now you're trying to raise equity in a falling market. That's costly, that's not a great idea, right? Or you try and sell assets. What kind of assets? Mortgages, not really, right? Loans, not really. So the other option is to not lend. So now the economy is starting to go down and banks are not lending. And what does that mean for the economy? It's going worse. So now the banks are actually fanning the economic cycle. If the economy is going up, they're actually helping it to go up even more. And if the economy is going down, they're helping the economy drive down even more. That's not what you want banks to do. You want the banks to act in opposite. So that was another issue. The other problem was, as you can see, the standardized approach relies on credit ratings. And a lot of the banks, even the internal models, linked to credit ratings. And that's when a lot of countries around the world recognize that they're not regulating credit rating agencies at all. Australia was one of the exceptions. Because in Australia, credit rating agencies are actually regulated. Because in Australia, a rating is considered to be financial product advice, and therefore rating agencies are required to have financial services licenses. But in most countries, including in the US, not regulated. So the entire financial system, credit risk, is reliant on credit ratings, and credit ratings production is itself unregulated. And there were significant problems in credit ratings and credit rating agencies. The other problem, assumptions. You know that in models, all the models rely on assumptions. And risk models rely on assumptions about what is the worst case scenario. So in this case, we talked about what's the 99th percentile worst case scenario. Unfortunately, worked out that what we thought was the worst case scenario was not the worst case scenario. Right? So what the assumptions that people made about large losses were not accurate. In US, it meant that some of the intermediaries tried to put, so all of those subprime loans that got created into subprime securitization vehicles. We didn't have that in Australia, but in US, that definitely happened. The other issue, and that was a really significant one, is that Basel II did not properly address liquidity risk. So if you look at Basel II, right, there isn't really anything specific to liquidity. And if you look at the Australian standard on liquidity risk management at the time of GFC, it was a couple of pages and it was extremely basic compared to what the liquidity standard is now. So liquidity risk was not properly addressed. And the other issue that was not addressed is the too big to fail issue. So before GFC, as I mentioned, all banks tried to get bigger. Why do banks want to get bigger? Economies of scale, chasing your customers, providing services globally, leveraging your brand value. There's a whole host of reasons. Right? But if a small bank fails, the regulators will allow it to fail. But there was no way that any of the large banks were going to be allowed to fail. There was no way that Bank of America was going to fail. In the US, every second household has a Bank of America card. I work for Bank of America in Australia, and in Australia it's a small foreign branch. So you don't recognize just what it means. I traveled to US once. You are in any US city, on every corner there's a Bank of America ATM or a branch. Everywhere you go, there's something Bank of America. Every second household has an account. What were the chances that the government would allow them to go bankrupt? Just like, what are the chances that, say, government in China would allow any of the big four banks to fail? Or, UK bailed out RBS because they were always going to bail them out. So, if you're allowing a small bank to fail, but you're not allowing a large bank to fail, it means that RBS, they were doing things they shouldn't have been doing. They were investing in things that they shouldn't have been investing in. Right? Citibank, their value was absolutely decimated. At one point, their share price was so low, technically it should have been delisted from the exchange. So, whereas from a capital perspective, there was no punishment. There was all this protection by being a large bank, but no punishment. So that was fundamentally the GFC. So what did the Basel III reforms bring? So Basel III, immediately, Basel II, GFC hits, regulators started working on reforms. So number one is to say, let's have more capital and let's have more high quality capital. So let's have more of common equity tier 1. Let's introduce an additional capital conservation buffer. Right, so that goes towards, let's have more capital. Let's introduce a counter-cyclical buffer to mitigate the economic swings. Let's introduce a leverage ratio. And the leverage ratio, so if you think about Basel framework, Basel capital calculation, the Basel capital calculation, the whole concept is it's based on risk-weighted assets. And then during GFC, regulators said, actually, some of the banks are getting so creative that if you look at their balance sheet, not looking at risk-weighted assets, but you just look at their balance sheet, it looks like they don't have a lot of capital at all. So let's introduce leverage ratio. And leverage ratio will be a non-risk-weighted ratio. So that just looks at your total exposure, essentially total assets. And at the very least, 3% of your total exposure has to be common equity tier 1. So that's the test you need to pass. And the national regulators could change those rules. So in Australia, we have 3% leverage ratio. In, for example, Netherlands, the local regulator said 4%. Non-risk-weighted 4% minimum capital requirement. Liquidity requirements. We'll spend some time on liquidity risk, but as I said, these standards changed. We have a fundamentally revised prudential principles 210, prudential standard 210, liquidity. And under the prudential standard, and this is common to all the jurisdictions, you have to calculate the liquidity coverage ratio, LCR, and you have to calculate the net stable funding ratio, NSFR. And those two ratios have a significant impact on banks' balance sheets, on their activities, and to some extent on the products and services that they make available to retail clients, and the price, and the selection of wholesale clients. And that's probably one measure you can apply to understand whether a regulatory reform is making a difference. So when in Australia the regulators made changes to residential loans, home loans versus investment loans, consumers could feel that. You go to the bank, and all of a sudden the pricing is now different between home loan and an investment loan. Previously it was the same, now it's different. Same with liquidity risk. These changes were introduced, and that changed bank behavior. So these reforms really blended. And the bigger the bank, the greater the amount of capital and the greater the amount of regulation that applies. So all of a sudden, post-introduction of these reforms, banks actively started to wind back their activities and trying to become less systematically important. And if you look at the footprint of major banks, the footprint of all the major banks has been shrinking post-GFC. They are reducing their risk-weighted assets. They are exiting some of the exotic jurisdictions. They're exiting some of the exotic activities that they used to undertake. In terms of capital enhancements, there's also some changes to banks' exposure to central counterparties. We'll come to that. Additional punishment for non-centrally cleared derivatives. So if you trade OTC, there's additional costs to doing that. Credit risk got revised. Securitization requirements got revised. Market risk is a work in progress. So market risk very much continues to be a work in progress. That model has been promised to be finalized for a number of years now, still isn't. And disclosure is continues to be revised. Now, I found this chart, and this goes to sort of close to 2018. And this is a Reserve Bank chart. So this just gives you an idea of where capital is going in Australia. So you can see that in Australia, total capital has been above 10%. Right? So Australian banks have generally been above 10%. And you can see that post-GFC, that number started to go up to about 15%. And also you can see that out of the 10%, it's only about 3.5% that was Tier 2 capital, and a higher percentage was Tier 1 capital. And post-GFC, if anything, Tier 2 capital started to reduce. And for smaller institutions, the capital was higher and continues to be higher. So, I found this table in one of the Basel committee publications, and I think this is a very good summary of what's happening with Basel III. It's getting a little bit dated, but it is a good summary. So we can look at it as this is Pillar 1, Pillar 2, Pillar 3, and then liquidity. Liquidity is done a little bit separately, and then here at the bottom, so that's for all banks, and then there's some additional requirements for systemically important financial institutions. So starting on the left-hand side, as we said, more focus on common equity and higher level of capital requirement. Right? Introduction of capital conservation buffer, introduction of the counter-cyclical buffer. We'll come to what they are. Risk coverage, securitization, trading book, counterparty credit risk, and central counterparties. Right? So the idea was that under Basel I, if you came across this, the idea was if you do a derivative transaction on exchange, the risk weight was 0. Because the view was central counterparties don't carry credit risk. Post GFC, the idea was, well, actually, let's introduce a 2% risk weight to exposures to central counterparts as well. Leverage ratio we discussed briefly. Pillar 2, additional governance and risk management requirements, so enhancement of the standards. Pillar 3, additional or enhanced requirements for disclosure. And then liquidity, much stronger requirements on liquidity. Plus, additional capital for systemically important financial institutions. So you see these acronyms called CFIs or GSIBs. GSIB stands for Global Systemically Important Bank. CFIs is Systemically Important Financial Institutions, kind of same thing. So, purely in terms of capital. So in terms of capital, the minimum requirements were 8%, and technically speaking, out of the 8% total, you were only required to have 4.5% Tier 1. As we said, Australian banks were generally carrying 10% total capital, and their Tier 1 capital was about 6.5%. So they were. And now we kind of go back to 2019. This is the Basel requirement. So these are the minimum global standards before you get into any local interpretation. So the minimum total is now 8% core, but you also need to have at least 2.5% capital conservation buffer. So therefore, your effective minimum is now 10.5%. Your minimum Tier 1 is 6%, and your minimum common equity Tier 1 is 4.5%. And the capital conservation buffer is all common equity Tier 1. So fundamentally, that means your common equity tier 1, so ordinary shares, has to be at least 7%. And total capital has to be at least 10.5%. Liquidity coverage ratio has to be 100%. Net stable funding ratio has also been introduced. In Australia, APRA introduced these requirements and the capital requirements much faster than the minimum standards. APRA pretty much went full on from the beginning. So, where are we with Basel III? So, Pillar 1 under the Basel framework is known as the ICAP, Internal Capital Adequacy Assessment Process. Right? So this process, Pillar 1, is about the bank itself. Pillar 1 is about what the bank does. The bank has to assess how much capital we want, and then do the calculations to work out risk-weighted assets and the total amount of capital. In terms of setting your capital targets, right, you've got to figure out how much you're required to hold, but how much also you want to hold based on your risk profile. And most banks hold capital more than the minimum required. It's also about what your rating agencies think. So more capital, higher rating you will get. But more capital is also more costly. So you've got to figure out what do you want to be. What are your strategic plans? Are you planning an expansion? If you are, you need more capital. So, what do we, this discussion around regulatory capital versus economic capital. So first of all, what is regulatory capital? That's the defined amount of capital the bank has to have. And as I said, it's kind of 8% plus the buffer, plus the capital conservation buffer, plus the counter-cyclical buffer, plus the systemically important bank buffer. And in Australia, we also have the unquestionably strong. So in Australia, this 8% minimum is actually going up to 8.5% for small banks, 9.5% for large banks. So again, you go 9.5 plus 2.5% capital conservation plus 1% for domestic systemically important banks. Right? All of a sudden, you're facing 13% of capital as a minimum. In terms of the economic capital, it's just an alternative calculation. So regulatory capital, you have prescribed models. Economic capital, you can have your internal models. And APRA expects that if you are a large bank, you will use your internal models to calculate capital. So therefore, APRA expects that you can use your economic capital calculations to work out your minimum regulatory capital as well. So, how do we do the calculation? Basically, with that equation we're used to by now. How do we calculate total risk-weighted assets? We calculate risk-weighted assets for credit risk, and there's two standards, APS 112 and APS 113. 112 is standardized approach, 113 is internal ratings-based approach. And then we also work out the amount of capital required for operational risk, APS 114 and 115. Again, 114 is standardized, 115 is internal. Market risk, which is APS 116. Interest rate risk in the banking book, which is 117. And risk for securitization, which is APS 120. So these are the actual standards we use in Australia to work out risk weights or capital. So for op risk, market risk, and interest rate risk in the banking book, we directly calculate the amount of capital required, and you can convert it back into risk-weighted assets by multiplying it by 12.5.
So, definition of capital. In terms of the definition of capital, you've got tier 1, and then you've got tier 2. It's interesting that the two types of capital are fundamentally different. We talk about total capital, but the idea is that tier 1 capital is known as going concern, whereas tier 2 is known as gone concern. So, going concern, what do you think that term reflects? Why do we call tier 1 capital going concern? What do you think? Why do we say this is going concern? Right. Going concern means that it's capital available to absorb losses as part of your normal operations. So the bank continues to operate, you continue to absorb losses. Gone concern means that it's capital to absorb losses if the bank is no longer operational. So going concern, tier 1 capital is there to ensure the bank continues to operate. But if you actually exhaust tier 1 capital, it means the bank is done. It's not technically bankrupt, but it's no longer operational. So, in terms of, different capital instruments, think of it in terms of who will be the first to get paid and who will be the last to get paid. So in terms of capital, the instruments that will absorb the most losses, they'll be the last to get paid in a bankruptcy. So common equity tier 1, that they take the first loss. So that's the best type of capital. And then you can work your way up. Ranking above ordinary shares are preference shares. And preference shares can qualify as additional tier 1 capital. Perpetual subordinated unsecured debt, they can also qualify as additional tier 1 capital. Term subordinated unsecured debt, that would qualify as tier 2 capital. And then you go to unsubordinated debts, and then you go to secured debts. They don't qualify as capital at all. So essentially, all of the capital instruments, they're there to protect, in particular, depositors from losses. Tier 1 capital is to protect the bank as part of BAU activities. But if you get into tier 2 capital, that's where the bank has already finished operations and it's just in the rundown mode. Now, interestingly, I never realized just how complex the definition of common equity tier 1 is. As I said, I write it on the board, I say, yep, ordinary shares, we all understand what it means, but the actual definition is very, very involved. So, what is common equity tier 1? Common shares, stock surplus, retained earnings, common equity, common shares issued by consolidated subsidiaries, and there is a Basel document, and in this case there's an APRA document that actually explains here are the criteria for something to get classified as ordinary shares. So it has to be the most subordinated claim. The claim on residual assets is proportionate with its share of issued capital. Principal is perpetual. Right? So an ordinary share cannot have any maturity. It has to be a perpetual instrument. The bank does nothing to create an expectation at issuance that the instrument will be bought back, redeemed, or cancelled. So you can't say, listen, I'll issue you some shares, or I promise I'll buy them back 5 years later.
I just need to go through this process. Distribution are paid out, so the dividends are paid out of distributable items, and the level of dividends is not linked to the amount paid at issuance. So you cannot say we will pay dividends 5% of the face value of the ordinary shares. So ordinary shares, there must not be any linkages between the face value or the price at issuance and the level of dividends. No circumstances when distributions are obligatory. So you cannot have mandatory dividends. Distributions are only paid after all the other payments have been made. You take the first and proportionately greatest share of the losses. The paid amount is recognized as equity capital on the balance sheet under the accounting standards. The paid amount is recognized as equity. It is directly issued, and the bank cannot directly or indirectly have funded the purchase of the instrument. That one is quite interesting, because that one is where, in Iceland, a number of bankers went to jail. Because imagine, we talked about a crisis. In a crisis, I don't have enough capital, I need to issue capital. But nobody wants to buy. So, what did some people do? I desperately need capital, otherwise I'll fail my minimum requirements. So instead of making a home loan, I say, hey, I'll lend you 100 million, and then you buy 100 million worth of my shares. So on the face of it, you have a loan, and then independently you increase your equity. But in practice, that loan is just lending for your own shares. It's not actual loss absorption capital. And that's what a number of banks in Iceland did by arranging various dodgy transactions. So the bank cannot fund its own shares. The amount is not secured or covered by a guarantee. It's only issued with the approval of the owners. It is clearly and separately disclosed on the bank's balance sheet. So these are just the key requirements for something to be classified as common equity tier 1. Additional tier 1, there's similar requirements, right? And then there's tier 2. So tier 2 is known to is the loss absorption on a going concern basis. And it does include some loan loss provisions. Plus, we also made some of the adjustments to tier 2 capital. So what are some of the examples of tier 2 capital instruments? Perpetual preferred stocks carrying a cumulative fixed charge, and that are hybrid instruments. And if you have subordinated debt with the original maturity of at least 5 years. Now, interestingly, from 2013, these instruments must have an option to be converted to equity capital or reduced in value. So this is what's known as the mandatory bail-in provisions. The idea being that if this is your capital instrument, right, the regulator should have the ability to convert it into ordinary shares. Because in a crisis, ordinary shares will act as a buffer against losses. So imagine you're buying, and this is why in Australia there's a big debate about retail investors buying tier 2 instruments. So if you buy, preference shares that pay a particular dividend, to what extent have people read terms and conditions to recognize that in a crisis, these instruments will be worthless?
All right, deductions. So in terms of deductions, we talked about some of them. Goodwill and intangibles, we mentioned, it's not a tangible asset, so in a crisis, has zero value. If it has zero value in a crisis, therefore, we exclude it straight away. Deferred tax assets. Can someone help me with deferred tax assets? Taxes that you may have paid for. So, for example, if you make a capital loss, right? So there's capital gains tax, but if you make a capital loss, you can carry forward your losses until you have a gain. Once you have a gain, you can offset the gain against the loss and not pay any tax. So having these losses is an actual asset. But in a crisis, you can imagine if Lehman Brothers were carrying forward some losses. Would they really help Lehman Brothers in a crisis? No, because you cannot sell them. Right? So deferred tax assets, shortfall of provisions. So if you haven't provisioned enough, you have to deduct that from capital. Defined benefit pension assets, we don't have that in Australia. And any investments in common equity tier 1 instruments of banking, financial, and insurance entities. So all of that acts as a deduction from capital. From that point is pretty much why banks stopped or reduced their investments in other banks and other overseas banks, because it is punitive. If you buy 100 million worth of shares of another bank, you have to reduce it counts as a reduction in your own capital. So it's quite costly. Just to give you an idea, I found this table, and this is New Zealand, right? So again, remember, 8% is the minimum. In New Zealand, every bank was already about 10% common equity tier 1. And by the way, right now, they're talking about increasing these standards. So if you compare this to, say, US, in US, common equity tier 1 was at the very minimum, somewhere here. In New Zealand, it's all the way up there. So New Zealand banks have had a lot more capital. And right now, the central bank is trying to get them to hold even more. Now, interestingly, if we look at Australian banks' capital, so to give you some ideas of what does the Australian industry look like. Unfortunately, I only found the data post-GFC, and this is 2010. And this was from one of the RBA publications. So for Australian banks overall, 80% of capital is tier 1, 20% of capital is tier 2. But if we break it down, the interesting things are that 70% is ordinary shares, 32% is retained earnings. The preference shares and convertible shares are actually quite small. So they're only about 16%. But deductions are 37%. So Australian banks still carry quite a lot of positions that require deductions from tier 1 capital. So that would be your intangible assets, deferred tax assets, investments in other banks. Provisions Australian banks are okay with. So yeah, you can see that the reserves and minority interests are quite small, but the other deductions are quite large. But the point stands that in Australia, the vast majority of capital is ordinary shares and retained earnings. That's how Australian banks read capital requirements. And if we look at tier 2,
Tier 2 will put term subordinated debt, other instruments, and then also deductions. So ultimately, we've got about 20% net in Tier 2. And then the next point, the next table, it's also 2010, but I don't think it fundamentally changed. Now, when we talk about different risks, and as I mentioned, we start talking about risk management, we start trying to figure out which risks are important, which ones are not. Ultimately, it comes down to how much capital a bank's carrying and what risks they're addressing. So, credit risk represents 85% of total risk-weighted assets. So that's why, when we talk about market risk, traded market risk, so all of those VaR models, expected shortfall models, for Australian banks, that represents 2% of your total risk-weighted assets. And this is why I say, for Australian banks, they don't particularly care. This is not a big deal. Right? So whichever model you use, the calculation is not that significant. Interest rate risk in the banking book was 3% of total RWAs. So where are the other risks coming from? Operational risk was 7%, and then securitization is 2%, and other, whatever that is, 1%. But ultimately, it means that by far the vast majority of risk on the Australian bank's balance sheets comes from credit risk. And again, step back, Basel I only covered credit risk. So if you had a good model under Basel I, you would still cover, in Australia, about 85% of total risk exposure. And within that, so you've got the exposure, so that's kind of the size of the balance sheet items. That's the gross assets. So in terms of the gross assets, you can see that mortgages are by far the biggest item. So Australian banks are known to have the highest exposure to home lending. So Australian banks, generally speaking, don't trade, and the vast majority of their risk exposure comes from credit risk, and within credit risk, they are overexposed to housing market. So Australian banks kind of live and die by the strength of the housing market. So if you look at it, the mortgages, they have the exposure of about 1.157 billion, so it's over 1 trillion, but the average risk weight is 26%. Which means that risk-weighted assets is only about 302. Corporate loans for Australian banks were 472 billion. Risk-weighted assets was 370. Sovereign, it had about 100 billion of exposure converted into 7 billion of risk-weighted assets. Exposure to banks, also about 100 billion converted into 18 billion. Right. And you can also see that the exposure to securitization was not significant. So this is where, coming back to last week, I didn't really feel like using an American textbook for us made a lot of sense. Because if you looked at the US industry, their risk-weighted asset composition would be very different. So they have different exposures. They have different industry, different types. The Australian industry, I'd probably suggest in our region, Japanese banks would have quite common structure to this. A lot of the banks in China, especially the domestic ones,
they would have, again, overexposure to credit risk and overexposure to residential lending. There isn't really that much trading. For some reason, this culture of trading instruments just never came to bear with the Australian banks. So that's the risk-weighted assets. Now, to give you an idea, so I looked at CBA, and this is using the December 2018. And as I said, I think I'm the key user of Pillar 3 disclosure. So this table comes from CBA's APS 310, 330 document. So that's the Pillar 3 disclosure document. So let's look at what is their total risk-weighted assets. So in terms of the total risk-weighted assets, so for CBA, total risk-weighted assets were 445 billion. So this is as of the end of last year. 445 billion total risk-weighted assets. Of that, 370 was credit risk. 370 out of 445. Traded market risk, 5 billion. Interest rate risk in the banking book, 13. And operational risk, 56. So you can see, traded market risk is just not an issue. So we will cover the models. I think it's an interesting thing to understand. And certainly market risk models, they do, the concept of that model is an important model to understand. But, you know, you can see that for CBA and for all the other banks, they continue to reduce their risk-weighted assets for trading. That's just not their strength. Interest rate risk in the banking book, that has fallen quite dramatically. We are in a very low risk, interest rate risk environment. But the interesting one is that operational risk has gone up from 41 to 56. But I am interested in seeing the breakdown of that number, and I'm interested in seeing how that operational risk figure has developed over time. Now, I got one of the questions from one of the students about whether conduct risk is part of operational risk. Now, for the purposes of this calculation, conduct risk falls under operational risk. But in terms of practically managing them, you know, compliance risk, legal risk, all of it, all of it falls under operational risk. But practically speaking, you have a legal department, you have a compliance department, you have an operational risk department. More and more so, you're finding that you have a conduct risk officer. So often, practically speaking, conduct risk is managed separately as well. But for the purposes of calculations under the Basel framework, it does fall under operational risk. Okay, so how do the capital models work? As I said, our basic premise was we were starting with 8% as the minimum. We started with 8% as our minimum capital buffer. So now we have capital conservation buffer of 2.5%. Now this 2.5% is mandatory. And what it means is unless you have full 2.5%, your ability to pay dividends and your ability to pay bonuses gets reduced.
you can only pay full dividends and full bonuses if you have full 2.5% capital conservation buffer. The next buffer is the counter-cyclical capital buffer. Unfortunately, they both can be shortened to CCB, so I'm trying not to do that. So capital conservation buffer plus counter-cyclical buffer. The counter-cyclical buffer is between 0 and 2.5% as well. What does that mean? Basically what that means is, we talked about how banks would exacerbate business cycles. The counter-cyclical buffer works this way. If credit growth is going very fast, the regulator says, guys, more capital is required. And therefore, as the economy is growing, the capital requirements are going up. Now, the regulator will give banks 12 months heads up, but you don't expect this capital conservation counter-cyclical buffer to be used very often, only when the credit growth is very fast. To give you an idea, in some countries they have implemented it. So Sweden, they went to capital counter-cyclical buffer of 2%, as well as Norway. Iceland lost their banking industry in GFC, and the banks were completely decimated. But their recession was quite shallow, and then they started growing again. So they actually had to slow down banking growth by introducing a buffer. Czech Republic, Slovakia, in Australia we don't have it in place, but a number of countries have implemented these additional buffers. We then have systemically important financial institutions. So in terms of the systemically important financial institutions, what's the definition? I mean, it's not just about how large institutions are. Size is one of the criteria, but it's not the only criteria. Size, market importance, and interconnectedness, such that if they fail, it would cause a significant dislocation in the financial system and adverse economic consequences. So the idea being, you're large, but also you have market importance, which means if you are not in the market, consumers suffer. And if you think about different products, the one product that's probably the easiest to replace is loans. Because loans is the simplest product to make. It doesn't take much genius to do a loan. But there are other products that are much harder to replace. So for example, trading in OTC instruments. Not a lot of banks do it. Custody and clearing businesses, services. Prime brokerage services. Fund administration services. They are quite significant. Even a deposit account. For a company to change their deposit accounts would be a 6-month project. Because there's so many issues involved with a particular account. So, the regulators looked at it from two perspectives. Firstly, they created a list of global systemically important banks. So these are banks that are large, have market importance, and are interconnected globally, such that if they go down, there's an impact on a global economy. And when this standard was being introduced, one Australian bank was considered for this list. Can anyone guess what that bank was? ANZ? No. 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 Macquarie, correct. So interestingly, the big four banks The regulators quickly said no because they're not global enough. They're big, but they're not global enough. If Commonwealth Bank disappears, what's the impact on the global economy? What does Commonwealth Bank do globally that's so important? Not much. Neither NAB, no Westpac, no ANZ. ANZ has more exposure in Asia. NAB had some historical exposure in the US and UK, not very good. Westpac is quite domestic. So their overseas exposure is quite small, but Macquarie is a true international bank. So when that was under discussion, being on this list means that you are important from a global perspective, but this is not a good list to be on. Because what this means is if you are on the list, you have to hold more capital globally. So your minimum requirements go up. And Macquarie argued very strongly to say, hey, we're not that big, we're not that important, don't touch us. Right? So they managed to not get onto that list. I mean, there was a lot of discussion behind the scenes, I'm sure. The other element is domestic systemically important banks. So this is for regulators to assess their domestic industries and figure out if any of the banks are significant enough domestically to warrant additional capital. And again, you look at size, interconnectedness, substitutability, and complexity. And if you are systemically important, more capital. So, APRA had a look, and they kind of tried to assess how to, what figures to use, how to assess banks to figure out are they systemically important or not. And they looked at size, and the GSIB framework talks about total exposures. IMF looks at total resident assets. APRA looked at the same. Interconnectedness, APRA looked at inter-financial system assets and liabilities. So in other words, how much do banks have in terms of assets from other banks, and how much do they have liabilities to other banks? Substitutability, how easy is it to replace the service? And you can see that the figures that the parameters or the variables that APRA looked at, assets under custody, so that's custodian services. They're quite hard to replace. So this is asset custody. So if you hold, if you're a fund manager, you manage funds, but you appoint a custodian. For example, HSBC, you appoint a custodian to hold those assets in trust for your clients. Payment fee. So again, moving your transactional accounts is quite painful. Underwritten transactions in debt and equity, and then APRA did look at total loans and total household earnings. And in terms of complexity, right, how complex are the institutions? They looked at notional amount of OTC derivatives, and they looked at how much is in the trading book, the size of the trading book, and risk-weighted assets for traded market risk. So then APRA assessed the Australian banks under those categories, under those variables, to figure out which ones are systemically important. And in summary, they said, we can't differentiate ANZ, CBA, NAB, and Westpac, right? So we're not going to apply different categories, but we will say that they are systemically important. So therefore, all four of them get a bonus, 1 additional % of capital. So right now in Australia, countercyclical buffer is 0. Right? But for big four banks, you need to have this, plus this, plus this, at the minimum. If you're not having this as a minimum,
then your ability to pay dividends and bonuses is reduced. So it means that if you only have a little bit of your conservation buffer, right? So if you only have a little bit of this, 25% of this, then you can't pay any dividends or bonuses. And it's only if you have everything that you can pay full bonuses and full dividends. So then, that wasn't enough. And in 2014, we had the Financial System Inquiry. The Royal Commission looked at in particular misconduct. The Financial System Inquiry looked at post-GFC financial system to say, what do we need to do? How do we fix? How do we improve the financial system? And recommendation number one out of the FSI was APRA should set capital standards such that Australian ADI's institution capital ratios are unquestionably strong. So that terminology came out of the FSI. APRA already did that. And then the FSI said, no, you have to make sure that they are unquestionably strong. Why? Because you want to ensure that banks can continue to lend and provide other services during periods of financial stress. So the idea being that you have more capital so that if there is stress, you can actually run down that capital, right, without stopping your activities. So the regulator should allow you to run down your capital, but you can continue to provide those services. What does unquestionably strong mean? So, in terms of the APRA's view on what's unquestionably strong, or in terms of the Financial Stability Inquiry view, before any crisis happens, unquestionably strong means that you have a level of capital high relative to the peers, and market players understand and perceive your institutions to have a high level of capital. Right. And they're confident that this relatively strong position will be maintained. So before any crisis, there is a perception that you are a highly capitalized economy. During the crisis, the banks will continue to lend and provide other critical functions such as credit and payment services, and they will have access to capital markets, and you will have a lower likelihood of bailout. So that's the purpose of additional capital, unquestionably strong capital during the crisis. So, APRA thought about it, and said, all right, well, what does it mean, numerically speaking? And what they said is, right now, so this was, back when our starting point was 8%. And we're not even talking about the capital consideration buffer, we're just talking about the minimum. APRA said, well, banks have 8%, plus they're already carrying margin because they know that there's more capital requirements coming, right? So, first step is we will increase the expectation of more capital. So by January 2020, which is, we're in September now, so by January 2020, Australian banks, major banks, should already carry 8% plus 2.5%, plus 2.5 plus 1. Right? So essentially they're saying that in December 16, practically speaking, Australian banks are doing this and they're doing this, and they are already carrying 9.5% because they know that there's more capital requirements coming. By January 2020, APRA wants Australian banks to take this number and take it to 10.5%. Technically speaking, the requirement is still 8, but the expectation is that they will carry 10.5. And then, by January 21, the actual minimum will move. So by January 21, this number will finally move to 9.5%. But then APRA, practically speaking, expects banks to carry 10.5% anyway. So that by January 2021, which is not that far away, Australian banks will carry minimum 9.5%, your minimum capital ratio, plus 2.5% capital conservation buffer, plus 1% domestic systemically important bank. So that means 12, 13, plus 1 more percent as a buffer. So that means by 21, they will have a minimum of 14%. Minimum. Practically speaking. The next slide is just for smaller banks. Right, so for non-major banks. And for non-major banks, it's just smaller requirements, but they're not as exciting. So, what did APRA say? APRA said that the financial stability inquiry looked at capital common equity tier 1. And by the way, these increases, that's common equity tier 1. APRA's view is that capital is important, but they do want to look at other factors as well. Now, this is what APRA said as they introduced some question with strong. So they said we do want to look at liquidity, funding, governance, culture, risk management, asset quality, other changes, and any additional loss absorbing capacity. So additional loss absorbing capacity would be tier 2 instruments, convertible bonds, other instruments that can be used. APRA ultimately wants to reduce the probability of failure, but they're not trying to eliminate the probability of failure. No regulator is trying to do that. Right? So no regulator is ultimately trying to get rid of the chance of failure by the bank. Leverage ratio, finally, as we said, 3% capital divided by total exposure, non-risk weighted. And then different countries can actually increase that ratio as well. In terms of the criticisms, Basel III has already attracted criticism, and whilst Basel Committee is not talking about it as a Basel IV, but if you Google Basel IV, you will see a lot of publications that talk about the reforms to Basel III. So in terms of some of the standard criticisms, credit risk is still, the modeling for credit risk is not very good because there's over-reliance on internal models, and if you had a portfolio of 100 loans, 100 corporate loans, and you mentioned that each one of you represents a different bank, major bank, significant large global bank. If I took these 100 loans and asked all of you to do an assessment, you will give me 35 different answers. So part of the problem is credit risk is the most important